Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring someone in and talk about the stuff that we care about that's happening at the moment. And there's nothing more happening right now than currencies and commodities. Welcome back to Dan Bell from HiFX, senior dealer there. Dan, last night, extraordinary action on global financial markets. What on earth happened?
Yeah, and a very, very big night for the financial market. So a huge sell-off in commodity prices. We saw oil prices drop almost 10% overnight. This week alone, we've seen silver prices down 25%.
Wow.
Gold prices off about 8%. So across the board, commodities have absolutely been hammered. And everything had sort of been building up to last night's event with the ECB announcing interest rate policy. We'd seen the CME group raise the margin requirements around silver futures, so they've made it more expensive for speculators to trade silver, and so that had been a key sort of theme throughout the week. And then it just sort of all blew up last night, and everything really reacted. Currencies down significantly.
Let's pick it apart. Firstly, the ECB decided to hold interest rates. Why was there such a big move then in the euro versus the US dollar and US dollar strength?
So the euro had pushed up to almost 150 this week, leading up to the ECB announcement last night. Markets were expecting the ECB president to use the language strong vigilance, and he didn't use that language. And markets took that to mean that we're not going to see an interest rate hike from the ECB in June, and that's been a key driver of the euro strength recently, and also I think a broad key driver of US dollar weakness, with that interest rate differential between the euro and the US dollar tends to be like one of the main sort of gauges of US dollar direction.
And there is a strong relationship, isn't there, between commodity prices and the US dollar?
Absolutely. So, I mean, generally speaking, commodity prices are priced in US dollars. And I think you have to look at, the price action that we've seen this week, and really, a correction was due. I mean, commodity prices have had a huge run up. We know the New Zealand dollar, opening this week around 81.20. The Australian dollar making it as high as 110. The euro almost up at 150. Oil prices over 120, gold and silver prices making these all-time highs. So I think a correction was due, and I think what we've seen, particularly over the last 24 hours, is a lot of the speculative, froth, if you like, has been taken out of the markets, and we've seen a big reversal. And
so the commodity currencies, Canadian, Australian, New Zealand dollars, really have come off this week.
They have, and the Aussie dollar, dropped down to, dropped from 110. It opened on Monday down to a low of around 105 overnight. So, pretty significant drop. The Kiwi was up at 81.20. We dropped down to the low 78s overnight.
So moving away from the commodities US dollar story, the differences between the Australian and New Zealand dollars, we saw a bit of movement this week. What's going on there?
Yeah, we did. So earlier on in the week, the RBA announced interest rates. They left rates on hold at 4.75%, but they weren't as hawkish as perhaps the market was expecting. So on the back of that, the Aussie dollar came under some selling pressure. The Kiwi Aussie exchange rate dropped down to a low of around 73 cents. Which isn't too far off that 20-year low that we had after the Christchurch earthquake. But since that less than hawkish statement and a much weaker than expected retail sales number from Australia yesterday, with retail sales coming in at minus 0.5% compared to a consensus of about plus 0.6%, the Aussie dollar has underperformed relative to the Kiwi, and the Kiwi-Aussie cross rate back around 74 cents today.
It's amazing, isn't it, with Australia? They're the lucky country with this commodity price boom, but their consumers in the retail sector aren't doing so well.
Yeah, and we've been hearing it anecdotally for a while that retailers have been struggling, and obviously the interest rate hikes that the RBA have been undertaking are certainly putting some pressure on consumers. But I don't know if we want to get too carried away about one data set. I think we need to see some kind of trend there, and obviously there's always going to be noise around one piece of data. But anecdotally, it supports the recent, weakness in retail sales. So, yeah, it is interesting to see, Australia, and obviously it is, by all accounts, still the lucky country. But I don't think it's as smooth sailing as perhaps some people may think.
Now, looking at the Kiwi pound cross, a lot of New Zealand rugby players looking to move their money back and forth. What's the story there? Because there's been some news out of Britain on interest rates and the economic outlook, and it may have changed views.
Well, the UK data, I mean, it continues to be very, average to bad, and there's sort of no denying that fact. But at the end of the day, interest rates in the UK are currently set at 0.5%. And our expectation and the market's expectation is that despite the weaker than expected growth outlook for the UK, that the Bank of England will start raising rates, sometime this year. So the Bank of England left interest rates on hold this week, but we didn't get any comments because their policy, if they don't change the rate, they don't actually give any comments. So we'll find out in the Bank of England minutes in the next week or so where their thinking is. But the Kiwi pound dropped from sort of almost 49p down to a low over the last sort of 24 hours, around sort of 47.5. So it has been actually, on a little bit of a downtrend.
Now, looking at China driving so much of what's happening in this part of the world, one of the reasons cited for the sell-off in commodities was comments from the People's Bank of China about slowing growth. But what should we look out for in China that could move markets?
Yeah, so China has been tightening interest rate policy and monetary conditions, since October last year. They've come out this week again and indicated that they are going to have to be more vigilant around inflation. So, markets are expecting further tightening from China, and so we're going to be watching the Chinese data. CPI and PPI data are released next Wednesday, and that's going to give us a gauge of inflationary pressures in China. I think it doesn't take a rocket scientist to know that there are some there are inflationary issues in China, particularly asset price inflation with their property market. So China's going to be an interesting one to watch. Over the next 2 years, hopefully they can get things under control. But clearly there are inflationary risks there, and if they start to raise rates too much, I think the world is saying, well, maybe that's going to slow their growth path down.
And one factor to watch is the renminbi US dollar cross. It's not very highly traded, but the Chinese are looking to free up trade of the renminbi, and it does seem to be appreciating a little bit against the US dollar. I mean, quite a bit of trade flow between New Zealand and China. I mean, how are you looking at those movements?
Yeah, so China operate a sort of a fixed or a pegged sort of exchange rate regime. So they are keeping their currency artificially low against the US dollar. The renminbi has been appreciating, but the appreciation to this point, I don't think reflects the underlying fundamentals there. China wants to keep their currency weaker. It's in their best interest as an export-driven country. But part of the issue in the global economy is China's sitting on $3 trillion of US reserves. So as China continues to grow, they continue to accumulate these reserves. Part of the story in the global markets, particularly in the currency markets, is that China has been diversifying out of the US dollar, but they are still massively exposed to the US dollar. And for that to change, we need to see them liberalise their currency even further. And whilst it's gradual, I don't think it's going to happen overnight. So those global imbalances that we're seeing are still very much a concern, and unfortunately, I don't think there's going to be some kind of overnight fix to that. So, something to watch.
So, looking ahead, some big numbers tonight, and we'll include those in the comment stream under the story once we've got those. But jobs figures in the US, the world's biggest economy, what are people looking for? How big an issue is it?
Yeah, so job figures, non-farm payroll, employment data released in the US tonight around midnight New Zealand time. Market's expecting a gain of about 190 to 200,000 new jobs for the month of April, and unemployment to be around 8.7, 8.8%. So if that number comes in weaker than expected, a lot of analysts will start to revise down their forecasts for GDP growth in the States. That'll be a broadly negative, create a broadly negative tone for risk appetite, and potentially we see further sell-off in risk, if that was to happen. But likewise, data out of the States this week has been pretty average. There was a US non-manufacturing services data out earlier this week, and that came in much weaker than expected. So there's been some concerns about the growth outlook for the US. That's also caused some of the volatility that we've seen in global markets this week. And naturally, with oil prices up over $120 a barrel, that's also a concern for the global outlook. So seeing that weakness in commodity prices, seeing the oil price come off overnight, could actually start to turn out to be a little bit of a good thing as far as the global outlook. And
never a dull moment on currency markets. Dan Bell there from HighFX with our weekly currencies outlook and review. And we'll see again next week if we see such volatility repeated. I'm Bernard Hickey. That was another in our series of double shot interviews here on interest.co.nz.